Welcome to Bruce Hurwitz Presents Meet the Experts. I'm your host, Bruce Hurwitz of Hurwitz Strategic Staffing. You can find me on the web at hsstaffing.com. I hope you will consider us for all your staffing, career counseling, and speech writing needs. I am delighted to be joined today by Robert Klausner. We'll be discussing the 2018 tax regulations and what's new. Rob, welcome to the show.
Good morning, Bruce. Good to be here.
Well, it's my pleasure. Please take a moment or two and introduce yourself to our viewers.
My name is Robert Klausner. I'm a tax partner with the CPA firm of P&K CPAs in Parsippany, New Jersey. We're a full-service accounting consulting firm. We handle everything from small individuals to multi-million-dollar corporations. We do financial statements and small business consulting.
I have one question before we get started, which may not be fair because tax season really hasn't begun yet. So you may not have received enough data from your clients to be able to answer this. But based on what you know today, and I realize this is a very general statement, will we, generally speaking, be better off with the new tax code or not better off with the new tax code?
There is going to be a lot. There's going to be a big mix of everything this year with the new code. Some people are going to benefit, and some people are not, as with everything. So there was a lot of changes, substantive changes that are going to hit a lot of the people, the individuals and the corporations that had big changes passed through entities. So at the moment, it's very difficult to say. I will say this: the IRS recently released a statement in the last 2 weeks saying that they going to charge underpayment penalties and interest this year for people if their withholding is off because of the new law. So they're anticipating some issues.
Okay. And one more question. Is it easier for accountants with the new system?
No, there is a tremendous amount of law out there that changed, and a lot of it has not been memorialized yet in regulations. They just recently, one of the big sections is a pass-through. We'll talk about a little bit, we'll touch on briefly later, but it's called the 199A for pass-through entities for people that are either self-employed or in a partnership or an S corporation. And they just sent out 400 and plus pages of regulations in the last 2 weeks.
So you have what to do.
Yeah, we have a little bit of catching up to do.
All right. So you were kind enough to prepare a deck of slides that I want to share with our viewers, and I'm just going to leave it on the deck. Usually I go back and forth, but there's so much information here. Let's just start. What are we looking at?
So this is what the new 1040 is going to look like. When you, this is a proof back from the summer, but it hasn't really changed much as they release it now. So in the old days, the page one had, if you recall, a lot of your schedules had a lot of the summary information of your wages and so forth in between. Here, this is just your basic personal information. So it's your name, your address, your dependents, and your signature. And that's all they have on page one here. So that.
Okay. So this then is what? The continue with
this is the second page. So this previously was incorporated all in page one. This is you'll see it in lines 1 through 10. Totals up. They cut out a bunch of lines, and now what they have is substantive schedules that are going to be, as you see on the various lines, will have backup schedules to add to it if you have anything for those. These are just totals.
Okay. And I believe this is the last form.
Right. So this is one of the schedules. So this was also on page one previously. Some of this would have down at the bottom part of page one previously. If somebody looks at their 2017 return, and this has all the miscellaneous income, the other income, and any adjustments to your gross income. And so, such as IRA contributions and moving expenses. Some of these things have been eliminated or removed. since as they've codified the new law.
What's the logic between 2 pages instead of 1? Okay.
Your guess is as good as mine.
Okay. All right. Let's get to the meat of the matter. And
so this is the new tax rates. So you'll see here on one more time, okay. You'll see this is for single individuals. On the right is what the old rates were and the bracket, and then on the left is now the new what it's going to be. So you'll see the first bracket doesn't change very much, a couple $100. It expanded. As you go up, it gets more significant from where they lowered the rate, and the rate at the upper levels by the time you hit the 12, 22, 24, that you see it drops by 3-4% per bracket, and then it also either expanded or decreased the range of the bracket.
Now, if somebody is earning, let's say, $50,000, mm-hmm. does that mean that they're at the 22% rate?
Well, it's not. It's a blended rate. So what happens is you would take the 50,000. It falls into that category. So the first 38,000 would come off at the 12%, 38.7 is at 12%, and then the difference between the 50,000, the other 11.3 would be taxed at 22%.
So why does it start with the 12% and not 10%? In other words, why isn't the first 9,525?
Well, it goes up as it's blended up.
Okay, so it does.
The calculation is actually blended all the way through. So you would end up somewhere probably around a 14 or 15% tax.
Okay. Again, I believe, yeah, here we go.
So this is the same thing, only for married filing joint, for married couples. Where they have the rates, again, the brackets have been expanded, and so to allow more income at a lower rate, and the top rate has been dropped from 39.6 to 37%, and it actually, in previous, as you see, the top bracket was 470,000, was at 39.6, so now it's over 600. So they expanded it by 100, over 130,000.
Now, is it, in the past, I've made a joke out of it and asked you, if, from a tax perspective, is it worthwhile getting married? I'm not asking it that way. Under what circumstances would a married couple not file jointly?
You see that normally it's very prohibitive to do married filing separately. The only reason you would do that is if one spouse has significantly more income than the other, and maybe they have some old skeletons in the closet where there might be some issues with some things that they filed, or they have a legal ruling or something hanging out there. In that case, you might want to, if the assets are kept separate and they can be clearly identified, then you'd want to file separately. Otherwise, for tax purposes, it's usually not beneficial.
Okay, let's move on.
So these are the new. So everybody's heard on the television and the news, how he doubled the standard deduction. So yes, so on the right in 2007,
he being President Trump.
He being President Trump, they went, and you'll see all the standard deductions from prior year to now in 18, how most of them have almost doubled. This is by itself, yeah, it's nice, but it also is in conjunction with a lot of other changes that occurred. So while people think that, oh, well, last year if they don't own a home and they were filing, married filing joint, and they got 12.7, so now they're getting 24, they're going to be very happy. For people that own homes and that previously did itemize, which you'll probably see in the next slide or two, a lot of your deductions have gone away, and this will be a big deal. So, and as you see at the bottom there, the personal exemptions. Everybody previously, when you were arriving at taxable income, you would take after gross income, you would take your itemized deduction or standard deduction, whichever was higher. And then you would be allowed a standard deduction, a personal exemption, which in 2017 was worth $4,050 per person that you were deducting on your tax return. And that would be you, your spouse, and any dependents that you were hired. So if you have a family of 4, it was worth $16,200. That deduction has gone away and not replaced with anything. So that's why this doubling of the standard deduction is not as big a hoopla as it appears.
All right. Now, please.
Yeah.
Oh.
So these are some other changes for that affect individuals. Previously, there was a child tax credit that was only up to $1,000 for each child under age 17. They've now increased it to $2,000, and they made part of it refundable. So if you have no other tax and you have a child under 17, you can qualify for up to a $1,400 refund on that credit. 529 plans or savings plans previously were only for post high school secondary schools. They've now been expanded with the use now with more young children being in private schools and private elementary and high schools, middle schools. They are now expanded the use of the 529 plan. 529 is where you can put money away for your child's education into there's millions of plans depending on the broker, and it grows tax-free as long as the money is used for one of these schools for qualified tuition and or expenses for the school. The itemized deduction phase out. Previously, depending on your income level, you would lose some of your itemized deductions, so that they eliminated a lot of the itemized deductions.
Okay, makes sense.
The one that affects people here in the Northeast the most is the cap on the state and local property tax deductions. So previously, you were allowed to deduct all of your state and local taxes, which, so if you live in New Jersey, any New Jersey withholding, or if you've made any other payments for something like that, and your property taxes on your home. We have the highest property taxes in the country here in the Northeast, and many people their property taxes are well over $10,000. So now that deduction combined, many people is now capped at $10,000. And that was the big blow for most of the people here certainly in the Northeast and in the West. It was where the property taxes are so high.
All right.
But just a note is it doesn't affect if you have a rental property, mm-hmm. or you're in the business of renting. Maybe you have an LLC that holds rental properties or a building or something like that. This cap does not affect that. The businesses are not affected. There's no cap on the property tax deduction for a business property. So that's a very important distinction. So if somebody a lot of people have rental homes, maybe they have a second home that they rent out, those properties are not affected.
Understood.
Mortgage interest. They changed the mortgage interest, just the cap. It used to be $1 million. You were allowed $1 million of debt on your primary residence. And now they lowered it to $750, only for loans taken out after December 15th or so of 2018.
Okay.
Miscellaneous. This one's a big one for sales reps, realtors, and whatnot that can't incorporate or they have a job where they don't get reimbursed for some of their out-of-pocket costs. You're people with very high investment advisory fees. If you have these high-flying brokers and they're charging you 2% of your value of your fund there. They used to be deductible. They were subject to a 2% limitation of your adjusted gross income, but now all those are eliminated. So as I put a couple examples there, the unreimbursed business expenses, investment advisory fees, and tax prep fees were the biggest ones that were subject to this. Legal fees for preservation of income, all those were something an individual would normally deduct, is now gone.
Don't remember the name of the form, but there was something that if you paid an outside consultant, I think it was $600
Right.
during the course of a
If you're
year.
a business, though, that's only for businesses. It's not for individuals. They're not required to anyway. It's a 1099 miscellaneous. So if you're a business and somebody performs services for you in any way and they are an individual or an LLC, you're supposed to issue a 1099 by the end of January to validate that deduction. And it also tells the IRS that they're supposed to be picking that income up.
Yep. Now, this one does impact me as a career counselor and a recruiter. Moving expenses eliminated. It used to be if you moved for a job, I think it was 30 miles, you could deduct the moving expenses. That's gone.
Right.
All right. Now, talk to us.
Okay, so the ACA came in with President Obama, and everybody was required to have health insurance. If you didn't have health insurance for at least 10 months of the year, you were penalized, and there was a penalty to pay. It increased every year over the last 4 years, and you would pay it as an additional tax on your tax return. And for some people, it was worthwhile that if they couldn't afford the health insurance, the penalty was lower than the cost of the health insurance. So if they were healthy and they felt that that was what they had to do, then that's what they did. So one of the things that President Trump did was he eliminated it. So after 2018, so in 2018 will be the last year that for federal purposes that there will be a health care mandate. So in 2019, if you don't want health insurance for federal purposes, you can skip it. However, the new governor of New Jersey signed into law back in July a health care mandate for all New Jersey residents. So if you live in New Jersey, you still need to have health insurance.
Now there's a form, again, I always forget the numbers, that you still need for 2018 that confirms that you had health insurance. So you can't file until you get that form.
Yes, whoever you have health insurance with, your provider is required to send you a Form 1095, and then it'll be, depending on how you're receiving it, whether you're employed or you're self-employed or doing it out through the marketplace, it'll be a 1095A, B, or C. And it'll have your name, it'll have the policy number, the policy provider, and then also the number of months you were covered. And as long as it was at least 10, you will have no problem. And they will issue those somewhere in the coming weeks. I believe the due date for that is February 15th.
Now, something very strange happened with me a few weeks ago. I received a letter from my insurance company, and I'm opening it up, and all of a sudden it turns out to be a check for $500. And they said that because of the new tax laws, they were sharing, and they called it a distribution. And they sent me a check for $500. It was rather surprising.
Run to the bank.
Oh, I already deposited right away. I did that right away. Now, first off, just curious, is that money I would have to pay taxes on?
You know what? I would say no, because it's a refund. It's not something that they're
said
paying.
It was a distribution.
It is a refund of your or rebate of your health insurance costs. Mm-hmm. So it would be netted against your I'm assuming I would have to take a look at exactly what they sent you and what the reasoning was. Mm-hmm. You're the first to tell me that they've received monies back. So I'd be interested to see it, but I would believe that it would, just from what you're saying, it sounds like it's just a rebate of your premiums, that they've adjusted the premiums, because there's nothing with the health law that changes the costs or anything like that.
Just if anybody's interested, it was Horizon, Blue Cross Blue Shield. Not that that's important. Right. Let's continue on.
So your medical expenses that we were just speaking of. So there was a limit that, they're subject to a limitation to take that deduction as well. Previous years, it was 10%. The TCNJ lowered the rate to 7.5% for 2 years, for 17 and 2018, the returns that we're going to be filing. But then it's going in 19, it's going back up to 10%. Again, it's unless you have very high medical and very low income, you're not going to see too much of this deduction. Long-term capital gain rate did not change. It's still at 20%. Same thing. There was no change in charitable contribution deduction, except they did. I'll amend that. They did raise the limit where previously you were allowed to deduct up to 50% of your adjusted gross income with charitable deductions. They've raised it to 60% if you are so inclined.
Yeah. Okay.
Casualty and theft losses. This was something that if you were somebody robbed your house or you had a damage from a storm, they were subject to limitations and a calculation, but they would allow you to deduct anything that wasn't reimbursed by insurance or whatnot. So they've now eliminated that unless it's a storm where where there's a federally declared disaster.
Understood.
This one's a good one for all those that were looking to get divorced and waited until 2019 to sign. Nobody has to pick it up. In the previous, the person paying would take a deduction and the person receiving would pick up the income. They've now eliminated that going forward in 2019. So it's still in place for the 18 returns, but if you signed your divorce after January 1, then you are under the new law where there's no income recognition.
So alimony is no longer taxable.
Alimony will be no longer taxable by the recipient, and it's no longer deductible by the payee.
Understood. All right. Pass-through.
So this is the biggest thing in the new law that everybody's been talking about. This is what I spoke about, that they just issued over 400 plus pages of regulations on. It's called the 199A pass-through. So this is for individuals that are either receive pass-through income from some business, whether it's their own business and they're a sole proprietor, or they are part of a member of an LLC, and they will and then there's several calculations and things. This is where all the accountants don't rely on necessarily the software. There's a lot of other things that have to be done. Anybody who's part of a pass-through entity should be seeking out qualified help, because this is quite complicated when you get into it, and there's a lot of hurdles to go through. But what they're essentially saying is that, you could potentially get back $20,000 deduction off of your pass-through income. So if you're in a partnership and you earned $100,000, you could potentially get back $20,000 of that as an off-the-top deduction. So you would be basically picking up $80,000 for tax purposes.
Okay. What's QBI?
So that's a qualified business income, and there's a number of different things. I explained there. It includes various incomes. It excludes certain gains. It's not for capital gains. It's not for sales of stock or things of that nature. So it does exclude certain things depending on the type of pass-through entity you are a member of. There's a lot of investment income, investment partnerships out there that are going to be excluded. So these are for operating businesses that are, and then there's certain service businesses where there is no tangible item, and maybe you're paying a lawyer or an accountant or a consultant for something, and those have different limitations on them. And this deduction is taken at the individual level, not at the partnership level.
Understood. Continue. Next.
This is all related. The deduction, like I said, it's in addition to the standard deduction or the itemized deduction, where if you back on that first 2 pages that we looked at the beginning of the deck, there was a line that says qualified business income deduction if you qualify.
Okay. So we'll go to the next slide. I like the name, but what is it?
So this is for tax for income children under age, that under 18 that have unearned income. So in the past, if you had a small child, maybe parents or grandparents opened up a bank account or bought some stocks in their name, they would get earned interest and dividend income. And in the past, it was over, once they earned over $600, they had to report it. And so rather than filing a whole tax return for them, they would pick it up. There were parents, there was a form in 8814 that where the parents, if all the child had was unearned income, which was interest and dividends, they could report it on their tax return. And there would be an exclusion and whatnot for the first $600 and so forth. So they've now removed that opportunity. So if a child has, now they raised the limitation for, so if they have over $1,050, they have to file their own tax return, and they will be previously they used to be taxed at the parents' rate, and now they're being taxed. The first $10,575 you see there is taxed at 10%, and then after that it varies based. It's going to go at the trust and estate tax brackets instead of the parents, which are different.
This could actually be significant. I always think about, every year some idiot gives a child a citation for setting up a lemonade stand. And every year it happens. Now, a child with a lemonade stand isn't going to make $10,000, they're going to make $1,000.
Right.
However, children today are very adept at using computers. Mm-hmm. And you could have a high school kid or even a public school kid, grade school, creating websites. And they could conceivably make a nice amount of money. So if it's over $10,575, they'll have to file, or
if it's over 1,000,
if it's over 1,050, they'll have to file, and they'll be taxed at 10% for the first 10.5 grand. Mm-hmm. All right. Now, tax reform for businesses.
So there was a lot of talk about this. So in the previous, we knew, as you'll see here, the tax brackets. This is the tax brackets for, and these are not pass-through corporations. So these are, this is for C corporation, what they call C corporations. So there you go. So the rates were below 50,000 of income. The rate was 15%. After that, it jumps up quickly, and top rate being 35%. So the new law changed that and put a flat tax of 21% on everything. So, which if you're a larger business making, over 50,000, it's a break. You're getting a benefit. You just dropped everything from as high as 35%. If you're really high, over 10 million, you're to 21%. There are some big companies that are really loving this. However, some of the smaller companies, if you were a small business and you're just starting out or just a small trucking along, and your net income is under 50,000, you got a tax increase. And nobody focused on that, and nobody said anything about that. They did add some other things, but one of the big things they took out was meals and entertainment. And this is when you're going out. Obviously, they were always subject to, they were deductible by businesses or for business purposes at a rate of 50%. So if you spent $1,000, you would put $1,000 down, and on your tax return it would be adjusted to $500. However, they've now removed the entertainment piece. So now when you take your client out to the ball game, the tickets to the ball game are now not deductible at all. But if you buy them the $8 hot dog, you can deduct 50% of that.
And sometimes the food's more expensive than the tickets.
Can be.
But what about a business owner who buys himself a meal? Is that still deductible?
It depends. If it is for, again, it's if he's out entertaining a client, it's business meal. It's subject to entertainment, the 50%. If it's for, hey, I'm working late in the office and I'm providing dinner for my staff, those are also There's still discussion of how that's being treated, but I'm sure it's going to fall under a lot of office expense.
And because most of the people who I interact with are like me, solopreneurs. I don't know, you go into the city, you have a meeting in the city, and you stop and you get lunch.
Right. So those should all be business meals. Those are you're working. It's all for business. You're not in there for pleasure. So it's that should be counted as a business expense.
Good. So, okay. Hopefully, I won't get too carried away here clicking. I think that's the last one.
So these are just some other things for businesses. Again, the 70% dividend received deduction was something for larger businesses that are getting dividends in. The entertainment thing we just spoke about, and the other things are again probably some for some larger corporations about some credits that were repealed, and how they would change for research and development credits. Much larger corporations though.
I hate acronyms. What is WOTC?
That is an acronym for the workers. I'm going to say, have me on that one. Off the top of my head, it's not something that we deal with. It's for a very large corporation. It's a credit that's available for workers, wage earners outside of some.
I can say this, so we'll say that it stands for workers other than Canadians.
Okay. There you go.
And I can edit all this out, so don't worry about it.
Okay.
All right. What is Section 1031 of the
Internal Revenue
Code?
There you go.
The S was missing. It threw me off.
So the 1031 allows people to, for business purposes, exchange business property and defer if you hold a property and it has a large gain built in. You bought it many years ago, it's depreciated, whatever, and it's increased in value. It's time to get rid of it, but you don't want to recognize that gain. So you go find another property that's of equal or more value, and you create what they call a 1031. So now you have to get involved. There's an intermediary company, a third-party intermediary company, that you go to them and you say, hey, I want to do a 1031. Here's the property I own. I'm selling it. Here's the contract. The monies go to the qualified intermediary upon that sale. And then there's several rules and regulations as far as dates, very time sensitive in order to do this. So when you do a 1031, you go to the qualified intermediary, you say, I want to do a 1031. Here, my business, my property is being sold. Here it is. They give them the contract. You have 45 days from that point to identify the replacement property. And then once you identify the replacement property, you notify the qualified intermediary in writing that here's the property we're replacing it with. Here's what I'm buying it for. And then you have then 180 days to close on that property. Again, all the monies go through the qualified intermediary. They will do all the calculations saying on the closings and everything else. And you then report that.
Go ahead.
As the deferred gain from the property, reducing the basis in that, so the gain is still captured for when you sell that property.
Okay.
And it rolls forward.
So let's move on. The gifted estate tax, otherwise known as the death penalty, I believe.
Well, this is but they pretty much removed it. I mean, for the 99% of the people, the good news is, Bruce, now you can give away $11 million to somebody in your lifetime.
It reminds me of the gentleman who was once said something about making his first million, and he said he tried to make his first million, he couldn't do it, so now he's trying to make the second million. So yeah.
So now they increased the lifetime exempt. The estate and gift tax are tied together. So during your lifetime, you're allowed to give away up to $11.1 million as of 2018. It gets indexed for inflation for federal purposes with tax-free. So if you die with an estate of $10 million, you'll pay no federal tax. State limits are different all over the country, so you'd have to check depending on where you live as to what the state estate tax is. New Jersey, for example, eliminated their estate tax. So if you die in New Jersey and you have under $11 million, you will pay no federal estate tax, and you'll pay no New Jersey estate tax. New Jersey does have an inheritance tax, which is for beneficiaries that are not your direct descendants, and that's something different. But but there's no estate tax on your income. New York's income. New York has, as you see below, I put down New York and Connecticut as well. There are limitations. So New York was under the old law, which was 5.2 million. They did not increase after that. So if you had $10 million, you would have no federal estate tax, but you will have some New York state estate tax.
Now, for most people, this isn't real, but
correct.
Even around here, this is significant for farmers and ranchers.
And it's significant for a lot of people. I mean, the majority. I mean, it really is. It does as far as because it really is eliminating then, as you said, the death tax for a lot of people that live certainly in New York and New Jersey. They increased the annual gift tax exclusion, went up from 14,000. Finally, it gets indexed for inflation every couple of years. Since there's been very little inflation, so it was at 14,000 for many years. Now it went up to 15,000 in 2018. So you can give away up to $15,000 per person without having to report it, as long as it's cash. If it's not real property or stock, something like appreciated property, something like that, then a gift tax return should be filed.
Okay.
So
soft drinks.
Yeah, COLAs are cost of living adjustments. They come out with these every year. There's usually these are on you see here. There was very few. These are all on your retirement plans. So depending on where you are, whether you're taking the first one, elective deferrals increased to 19,000. So previously, if you were working for some place that had offered a 401k, you were previously allowed to put away 18,500. So it went up $500 to 19,000 if you're under age 50. If you're over age 50, there's a catch-up of $6,000 that you could put in, but they didn't change the limit on that. So it was 18.5. It went up to and if you're over 50, it was 24.5. So they raised this $500, but they didn't raise the catch-up. Same thing for IRA contributions, went up from 5,500 to 6,000, and so forth for the other different plans that you may have at your job.
What is meant by catch-up dollar amounts?
Right. So that's what I was saying, that if you're over age 50 and you wanted to put in more than the 19,000, if you're working for a company and they offer a 401k, you could put in, you're not capped at 19,000. You could put in up to 24,500.
Okay, that's the catch. All right. Now, New Jersey.
So in 2018, we saw the second drop, as promised by the Christie administration, from paying for that exorbitant gas tax that they put in 2017. So the sales tax came down again, and it was so it's at 6.625 currently. The new governor is looking to raise it back up, though. Has not yet. Again, as I mentioned, the estate tax exemption was $2 million in 2017, and then they completely repealed it in 2018, so there's no more estate tax. The inheritance tax remains unchanged, and that was, like I said, for beneficiaries that were non-immediate. If they were not the children of the spouse or children of the decedent, then you paid what they called an inheritance tax on the value of the inheritance. So that was something that was paid by the estate, not by the beneficiaries. When it's a very big misnomer. I get questions like that all the time. That my aunt died and I'm getting an inheritance of $10,000. How much is that? Is that going to be taxable? Beneficiaries are never taxed on inheritance. It's always, if there's a tax, it's going to be at the estate level, at that, either for the federal or for the state they live in. Depends on the state.
Now, as you know, the mission of my company is to promote the hiring of veterans. So I like this income tax exemption of $3,000 for veterans.
Yeah, so that's something New Jersey put in last year, that they sent out a lot of letters to as many veterans that they had on the rolls. And if you didn't have it, if you couldn't find your DD
214.
Yes, your paper, your release from the Army or one of the armed forces, you could apply for it. They would find you in the system, and then you were allotted a $3,000 deduction or income tax exemption, basically on your New Jersey tax filing. So
that's off the top 100%.
Yes.
Okay.
So, and then New Jersey's increasing the exclusion for your retirement exclusion. So if you're taking, for those over 70 and a half and that are required to take pension distributions every year, they are partially excluded. So they've gone up, as you see here, the two columns. The first one's married filing joint, second one's for single, and they're increasing over the next couple of years. They've been increasing since 17. It was originally at 20,000, so now it's at 40 for married filing joint and so forth, going up 20,000 a year to be excluded from income. So if you have pension distributions that are taxable for federal, they may not be taxable, or certainly only part of it may be taxable for New Jersey.
I'm just curious, do you have to pay tax on Social Security?
Social Security is exempt if you have, and there's different limits, and I believe for single, I believe it's 25,000. So if you have limited other income, then the Social Security is not taxable, and there's thresholds for depending on your filing status. Once you exceed that threshold, then the Social Security for federal purposes becomes partially taxable, and it maxes out at 85% of the amount. For New Jersey, it is never taxable.
Just curious. The health insurance mandates.
Okay, so this is what we mentioned earlier, that Governor Murphy back in January signed legislation that, well, the federal government is eliminating the mandate for after 2018. Mr. Murphy put it back in after 2018 for New Jersey residents. So you still need, and there's the amounts that if you don't have it, that New Jersey will be charging you. Based on your income or the number of people in your return.
It'll be interesting if anybody challenges this in the Supreme Court, but it would probably go to the New Jersey Supreme Court.
Right, it's got to go through the New Jersey courts first, and I'm sure it is. I'm sure it's heading there, but it's not. As of now, this is the legislation that got signed in.
Mm-hmm. Believe we have one more slide. I may be wrong. Yeah, I was wrong. Rob, thank you so much. We've gone through a wealth of information, and I thank you. You provided great direction for our viewers, and I'm sure they appreciate it. And I will now put up that slide again so that people can see your contact information. If there's anything you'd like to say, to add, please.
Thank you, Bruce. I appreciate it. This was a lot of fun. If anybody has any questions, I would be happy to answer any. Shoot me an email. Give me a call. We're here. We're not January to April accountants. We're here all year round. Our firm is in the process of we're expanding actually in the next few months and getting stronger. We like to help our clients grow. If they do well, we do well, and it's That's what we do. So please feel free to shoot me. If anybody has any questions, I'll be happy to answer.
Rob, thank you again. And thanks for watching. And please keep focused on success.
Thanks, Bruce.